Welcome to The Explainer, where we dig into the details and give you the straight story.
All right, so let's get right into it. The latest earnings report from the defense and tech giant Leidos, it's sending some seriously mixed signals. We're going to break it all down for you.
So yeah, on the surface, it's kind of confusing, right? They absolutely crushed their profit goals, but then came up short on revenue. How does that even work?
Okay, let's drill down into that revenue number. It came in $4.21 billion. Now, that's not just a miss. They were off by about $107 million. And on top of that, it's actually a 3.6% drop from this time last year, so not great on the surface.
But, and this is a big but, here's where the story gets really interesting. The CEO, Tom Bell, he came out and said, hold on a second. He explained that if you adjust for a weird calendar quirk, an extra week last year, and a 6-week government shutdown, well, the business actually grew by about 4%. That changes things, doesn't it?
So, that's why you can't just look at one quarter in isolation. The real story, the much more powerful story, comes when you zoom out and look at the entire year.
And wow, when you do that, the picture completely changes. For the full year, Leidos had a fantastic run. We're talking revenue near the top of what they predicted, better profit margins, and get this, a 26% jump in free cash flow. That's huge.
So what's fueling all this? What's the engine behind this growth? It's simple, really. They've been winning new business, and I mean a lot of it.
Just look at the fourth quarter alone. They booked a staggering $5.6 billion in new contracts. That's in just 3 months.
Now that gives them something called a book-to-bill ratio of 1.3. What does that mean? It's pretty simple. For every $1 of work they finished and billed for, they brought in $1.30 of new work. That's the textbook definition of a company that's growing.
And we're not talking about small contracts here. A perfect example, a massive $2.2 billion deal with the U.S. Air Force to build advanced radar systems. You know, the kind that defend bases from threats like cruise missiles? That's a huge vote of confidence. Now, wins like that don't just happen by accident, right? This is all part of a very deliberate, very aggressive new strategy they're rolling out. They call it the North Star 2030 strategy. And listen, this isn't just some fancy slide deck for investors. No way! They are already in full-on execution mode. And you can see it in 4 big, tangible moves they've made. They're buying up key companies in cyber and energy, they're completely reorganizing the business, and they've brought in a new chief technology officer to really light a fire under innovation. So first step, they snagged a firm called Kudu Dynamics. This is a super specialized cybersecurity company. And the whole point was to get their hands on some unique tech and break into new markets. And apparently, it's already paying off big time. Then, boom, they announced a $2.4 billion deal for Entrust Solutions Group. This is a huge player in energy engineering. And the goal here is clear. They want to become the undisputed leader in that space. But you know what? Their biggest, most aggressive move isn't even buying another company. It's a massive, massive bet on themselves. And what does that bet look like? Well, get this. They are tripling their investment in themselves for 2026. I'm talking about their capital expenditures, a 3x increase.
That's a jump all the way up to $350 million for the year. That is a ton of money to be investing back into the business.
And where's all that cash going? Well, it's going right where it counts. They're expanding their production capacity for critical defense systems. They're building and upgrading top-secret classified facilities. And they're even co-investing with the government on the nation's most important security needs. Okay, so all of this action, all this investment, it sets the stage for what they expect to happen next year. So here's their official guidance for 2026. They're forecasting some really solid revenue growth, strong profit margins, the whole 9 yards. And the crazy part? This forecast doesn't even include the impact of that huge Entrust acquisition we just talked about. That'll be extra. But here's the key thing to watch. They're predicting that their growth is actually going to accelerate as the year goes on. They think it could even approach double-digit rates by the end of 2026. That's some serious momentum.
And this all circles back to what the CEO, Tom Bell, keeps saying. He's on a mission to create what he calls a new kind of national security company. One that can deliver both hardware and software at incredible speed and scale.
So the bottom line is this. Leidos is making some huge, audacious bets to become that company. They are putting their money where their mouth is. The big question is, will it all pay off? It seems like 2026 is going to be the year we find out if this massive transformation is going to deliver.